Yo, what's going on, man? Day 15, the final day, man. Y'all should be ready to take this swing trade and invest into the next level, man. Welcome to day 15. It's your boy Zay. Welcome back to Black Market Academy. We big dogs, and we here with the most important part. What I told y'all when we first started. I said risk management is one of the most important aspects that you will ever in your life come across when it comes to trading. Yeah, that was long winded. I know that was long winded. I had to get y'all. I had to leave it dramatic and suspense and all. I had to. But what else would I end it off with but risk management? Yeah. I know you want to see the best trading strategy in the whole world. You better not. If you came through this whole course, of course you don't want to see that. You want to know, Zay, how do I maximize my risk management? And here we go with position sizing. I can't talk because I'm too excited. All right. What is position sizing? We can actually lock in for this. We're going to lock in on the last one. Position sizing refers to the amount of capital allocated to a particular trade. It determines how much of your portfolio you're willing to risk on a single trade. So I look at position sizing and risk slightly different, right? Position sizing, you can use 100% of your position sizing and still risk 1 or 2%. That's how I look at it. So as long as you're risking 1 or 2% on a trade, you can still use $1 million. Because you can, like, say for instance, now it'll kind of be dumb because the more position size you use, the smaller your stop loss has to be. So keep that in mind. It can mess up your trade. But if you're cool with having a 2 cent stop loss, which don't make no sense. But if you're coming having a 2 cent stop loss and could possibly flip your $1 million to $1 million, and I mean, do whatever you want. However you make your money, it's how you make your money. I ain't gonna judge, but show me that. Please show me that method. If we only can risk 2 cents and make, you know what I'm saying? Show me that method, please, do. But so that's how I look at it. Key factors to consider when deciding position size include account size, the total amount of money in your trading account, risk tolerance, the amount of money you are willing to lose on the trade, and then stop placement, the distance between your entry point and the stop loss. This helps calculate the risk per trade. Yeah, so we were kind of touching on that. If you have a $10,000 trading account and you're willing to risk 1% of your capital per trade, your total risk per trade will be $100. So 1% $100, right? So you can technically use your whole $10,000, and depending on where your stop is, will depend on your 100. So say for instance, okay. I gotta do this right. I got to. The chart time. It's chart time. It is chart time. Welcome to Chart Time with Zay Stock. Remember, that's my name. My name is Zay Stock. Don't ever forget it. Zay Stock. All right. Okay. So, for instance, say we have a position size of $1 million because that's the best number in the whole world. Not it's like the second or third best number. Because 1 billion is like the second best, and like 100 billion is the third. 1 trillion is what's wrong with me? 1 trillion is like the best number in the world, right? 1 trillion is that number. Okay, we entered here, right? Just let it be red. Let it be red. We entered here. Now, if our position size, if our account total was $1 million, and we wanted to risk 2%, our stop loss would have to be like here, right? So obviously we would have got stopped out. That don't matter. This is not mathematical. I'm just giving y'all an example, right? So your stop loss would have to be so small that your trade doesn't have no room to run. You know what I'm saying? And you'll just be playing Russian roulette with whether you won that trade or not. Now, if you would have risked this 2% here, but then the trade ran up all the way here, then my buddy, you made you some money for real. Because if there's a 2%, then every increment is 2, 4, 6, 8, 10, 12, 14, 16, 18, 20, 22. That's like a 1 to, I don't even know it. Listen, you know what? We do know. We can know. We can know anything in the whole world, bro. We can learn anything. So that is a 1, 2. Let's just say we ain't hit the top now. Let's just say we sold out the consolidation. That is a 1, 2, 38. So we risked $20,000. We would have made whatever 20,000 times 38, which is insane. Let's just do 20. That's 20,000. What? X 38. That is what, 2 million? That's 20 million. That's 20 million. Oh, That's 3 zeros here. Yeah, 1, 2. Oh, that's 2 million. Okay, that's 2 million. So we would actually turn $1 million, but risking 20,000 to make 2 million. Would you risk 20,000 to make $2 million? I bet you would. So I mean, obviously you're playing Russian roulette, but just keep in mind, all I said, I did all this to say because I don't know, I just want to break up the charts for some reason. The more position size you use, the smaller your stop loss has to be on the chart. But say for instance, if we weren't using a whole $1 million and instead we were just using $10,000 and we wanted to risk, If we wanted to risk 20,000 on $1 million account, we use $40,000. We can enter here, and that $40,000 stop loss could really be like all the way down here. So we can really let the trade run. Now keep in mind, we can like put the stop loss right here and only be risking 5,000 out of the 20,000 we need to be risking, which is amazing. So you just want to, but you still wouldn't have limited upside. So I mean, obviously, you can risk 20,000, but you're only risking 5,000, which is like 0.05% to only make 0.05%. So you just gotta be smart because obviously at that point you're just not using your capital efficiently. So that's pretty much just how position size work. That's why I just say use 1 to 2%. Just be smart on how you want to use it. Just be smart. Usually they say the best way to do it is if you're entering here, from where you enter here, if you want your stop loss to be here, just make sure the stop loss you lose $20,000 here. Well, worst case scenario, and then let it be like that. That's the best way you can go about playing it like that. So that's how we're gonna do it. But that's pretty much that. All right. Why position sizing is crucial for risk management. Risk per trade. By determining your position size, you can control how much you stand to lose on any given trade. That is true. This helps protect your account from large drawdowns and ensures you can survive a losing streak. That's why risk management is so important. Because if you use too much or lose too much on your risk, you will not survive a losing streak. And it will literally take you multiple months to revive your account if you were to go on a losing streak. And at that point, you'd have lost all hope. Say, for instance, I turned 1,000 to, let's just say, let's give some good numbers, right? We turned 10,000 to 20,000 within a year, right? Within a year. We turned 2,000 to 20,000 within a year. We need to look at realistic numbers. First of all, don't think you're about to turn $10,000 to $1 million in the stock market. That's not happening. You can turn 2,000 to 10,000 if you're an amazing trader. You can turn $1 million to $1 million, but you're not turning $100 to $1 million. So don't even come in here thinking that. We're not coming in here thinking that. This is a game where you can sit on your butt, click some buttons, and turn whatever you got into more of what you got. That's about it. But the best investor in the world makes about 60. Jim Simons made about 60-something% return a year. So and obviously it was better towards the end of his life because of course in the beginning he didn't make a 60% return. So, but the losing streak, bro, if you can be the best trader in the world, if you're using too much position sizing, you gonna lose. You can be the best trader in the world. If your position size is too high, you will lose. It takes one trade to wipe you out. Let that simmer in your mind. Maximize long-term profits. Proper position sizing helps balance risk to reward by avoiding excessive risk on individual trades. You can stay in the game longer, give your winning trades a better chance to compound over time. Yes, Lord. The impact of too large or too small position sizes. Too large position size. Taking large positions relative to your account increases the risk, blowing up your account. A single bad trade with a large position size can wipe out a significant portion of your portfolio, of course. So that's the example. If you risk 1,000 on a single trade, $2,000 account, 10% loss result in 10% drawdown, which can be tough to recover. Keep this in mind. If you take a 10% drawdown, you have to get a 20% increase, okay? Which is not the easiest to do. We not, you know what I'm saying? So if we lose $100. So we got if we got let's say we got a $1,000 account. If we lose $100, we lost 10%, right? But to get back to that 1,000, we have to be trading from $900, right? Which is still a lot, but that 900 would, I could say, a 10% increase would only be what $90. So you're still out $10. So even an exact 10% increase won't give you your money back. So you would actually have to make like 12% or something like that. So you have to actually make more than you lost when you get a drawdown, because you can't still trade with the same amount. Well, I mean, you could, but I mean, why would you? I don't know. You do whatever you want, just win, make money, and then send me some when you make something. That's all. Too small position size. On the flip side, taking too small position sizes can prevent you from making meaningful profits, especially in volatile markets. So I would just explain that to you. If you have your stop loss at the bottom of hell and you try to swing it, even if you had a good trade, if you normally supposed to risk $20,000 and your position size is so low that you're not making no money, then you're not being efficient. You get what I'm saying? So you just I don't know what you're doing with that one. At the end of the day, we still want to make money. We're not trying to hope and pray and gamble and be dumb about it, but we definitely want to get rich for sure. So let's do it. Risk to reward ratio. One of the most important aspects of position sizing is determining the risk to reward ratio of your trades. A solid ratio helps ensure that potential reward justifies the risk you're taking. So we keep touching on these things because these are very important, bro. You don't need to know all the flashy stuff. Any indicator in general really can work. If you can make something work if you want it to work. But risk to reward is what's actually gonna make you a profitable trader. Nothing else. Not risk to reward, but risk management. Risk management is gonna make you a profitable trader. You can trade every time the sun come up, you can buy, and every time the moon come up, you can sell. And as long as you got risk management, I promise you'll probably make some money. You're probably gonna be better off than the person that's just trying to trade with 100% of his account every trade, just flip his money. But that's pretty much that. Like I said, 1 to 2 bare minimum. Like I said, like 1 to 5.5 is what I personally use. If you want to risk 1% of your $10,000 account and you're talking a 3% gain, you will adjust your position side at a 1% loss will only cost you $100. Absolutely. So that's just that was talking about adjusting your risk management. So if you want your stop loss, if you would like your stop loss here, make sure from here, make sure this is a $20,000 drawdown, $1 million account. If you were getting in a trade here, make sure that the stop loss here will be a $20,000 drawdown. Now, sometimes you will get really good deals. Like this one is a good compared to this one. See how big this stop is compared to this one. So this is a $20,000 drawdown. But the thing about this is, bro, look at the upside potential, bro. So you lost $20,000 here, but your risk to reward is so amazing. Your risk to reward is golden. So remember, like I said, we stopped out here. Remember that trade that last day. So we're gonna give ourselves the same stop loss. So we're gonna do it right here. 8.86. So we did 20,000 times 8. So that's almost $20,000 in that one trade. And this is shares. This ain't even optional. Imagine if you in options. Oh my God. If this is options. Oh my God. Yeah, for real. Okay. How to implement a position sizing strategy. You can do percentage based. You can do fixed dollar risk per trade. You can do volatility based, which is basically just adjusting the size based on the volatility. So if the ATR is $8 this day, then you adjust your stop accordingly. Comparison if it's $4, you would just cut it in half or ramp it up. So basically, say for instance, if the ATR on Tesla is 4, right? I would risk my 20,000 based on those 4 points, but if it was 8, I would then cut my position size in half. So if I was using, we'll go to add some text right here. We got 4 ATR. I would use a $10,000 account size, but if it was an 8 ATR, I would use a $5,000 account size. So that's what that means by ATR based position sizing, right? So you got percentage based, which is 1 and 2%. We touched on that like almost every slide because I need y'all to break it into y'all head. Fixed dollar amount is also kind of what I touched on about the $20,000 thing. I'm kind of more in for like I'm like a mix. I just kind of combine the two because I'm like, I say for instance, like if I got $1,000 account, I'd be like I'm looking to risk 100%. Not even, I said 100%. Oh my God. If I got $1,000 account, I'm looking to risk 1% or 10%. That'd be $100. But obviously it's $100, but still like the same thing as a fixed dollar risk. So it's kind of the same thing in essence, just depending on how you look at it. and then the trailing stop loss for the dynamic. I do trailing stops, of course. I do everything but the volatility. I don't really use volatility because I trade options, so I can just do that how I want to do that. I mean, I have a little bit more control with options compared to like if you was trading futures when it comes to that. So that's pretty much it. We had to end it off on the most important thing ever in the whole entire world. Yeah. If you think that position sizing, that risk management is boring, you're in the wrong game. Think about it like this, bro. If you playing football, most people think that working out is boring, but that makes you. Would you want to be Derrick Henry or would you want to be the leprechaun? You know what I'm saying? You got to put that work in. So risk management is like going to the gym. It's gonna make you stronger, but it's probably not. It's not the game. Of course, everybody like the game. We play football. We love the game, but you become better at the game when you put the work in, and it actually makes the game more fun when you get the. I'm not gonna say the word you know what I'm saying, but when you on everybody, you know what I'm saying, it makes the game amazing. You know what I'm saying? So that's pretty much it, man. I appreciate y'all for tapping in. I'm proud of y'all for making it to day 15. Let's make this money on it. And like I said, don't forget to send me something. If you want my email, drop it down. Send me some Bitcoin. Don't send me some XRP. XRP up right now. I'm up 400% on XRP. I ain't gonna lie. XRP, yeah. Shout out to you. So appreciate y'all for tapping in. Like I'm not playing. Really send me some money. Make some money from Strength Train. 100 million. That ain't nothing. You know what I'm saying? I taught y'all this. It ain't nothing. So I'm gonna see y'all when I see y'all. Peace out. Appreciate the opportunity. Black Market Academy. Let's get it.